Stop what you're doing right now, this second. Exit that trading app. Tell your spouse the crypto talk can wait. Get out of that meeting. I don't care if your boss is staring at you. This is bigger, much bigger. If you own silver, don't check your account until after. You'll either panic or celebrate. I need neither until you understand. January 20th, 2026. Something impossible 24 hours ago just happened. Silver hit $95.88. Record high. Never seen in my life. But here's what they're not telling you. That's the paper price. The price on your screen. The price you see on Bloomberg and CNBC and every financial website in the Western world. That is not the real price. In Japan yesterday, dealers sold silver at $130 per ounce. Let me say that again. $130. When they could find it, 80% premium over spot. This has never happened before. Not in modern markets. Gold sees 5% premium sometimes, 10% during supply crunches. Silver occasionally sees modest premiums in specific markets, but 80% across an entire region? The emperor has no clothes. And yesterday I told you this was coming. I told you the manipulation would not last. I told you the banks were too exposed. And you know what? It did not last. The manipulation cracked. The banks are bleeding. Numbers do not lie. Politicians lie. Bankers lie. The media lies. But mathematics is truth. And the mathematics right now are screaming. Yesterday morning, silver traded at $72 per ounce. This morning, $94. Spread $22 in 1 week. Let me say that again. $22 in 7 days. That's a 30% move on a commodity market in a week. This is not normal. This is panic. This is someone trapped. Look at what happened in December. Silver closed November at $68. By December 31st, it hit $83. $15 move. Then the exchanges stepped in. CME raised margin requirements once, twice, 3 times in 2 weeks. 47% increase. On January 7th alone, margins jumped to $32,500. That's not risk management. That's desperation. That's the referee stepping in to save the house. Because the house is losing. The official line? Market volatility, standard procedure, risk control. That's what they tell you. Here's what they don't tell you. The CME is not a government agency. It's a for-profit corporation. NASDAQ ticker CME. And guess who their clearing members are? JPMorgan, Goldman Sachs, Citigroup, HSBC. The same banks that are short silver, the same banks that need the price down, the same banks that control the board. So when silver surges and threatens their positions, the exchange changes the rules. They hike margins. They make it expensive to hold long positions. They force sellers into the market. It did not work. The margin hike did not work. The manipulation did not work. Silver kept climbing. Here's the data. COMEX silver inventories. December 1st, registered silver available for delivery, 80 million ounces. December 4th, 48 million ounces, a 60% drawdown in 4 days. That's not normal trading. That's a run on the bank. Physical silver disappearing from the vaults while the paper price says everything is fine. Shanghai paying $8 premiums per ounce over COMEX. India paying $5. Pamp Swiss dealers in Dubai charging $128. When they have stock, most of the time they don't. The smoking gun that proves the paper market is fiction. December 30th. CME Group announces problem with cooling system at data center. Servers shut down. Silver futures market closes. Timing, convenient. Silver was climbing through $79, looked ready to break 80. Exchange shuts down. When it reopens, silver drops 17%. 2 days later, silver touches 83. Exchange raises margins again. You see the pattern? Every time price threatens to break out, they change the rules. They raise costs. They shut down trading. They protect the shorts. Now let me name names. JPMorgan, HSBC, Scotiabank, BNP Paribas, Citigroup, Deutsche Bank, Goldman Sachs, UBS. These are the players. These are the banks with massive short positions in silver. And they have a history, not speculation, documented crimes, criminal convictions, billion-dollar fines. JPMorgan paid $920 million in 2020 for manipulating precious metals markets. Not allegedly, they admitted it. Guilty plea. 2 traders went to federal prison in 2023, served time for spoofing from 2008 to 2016. 8 years of manipulation. How much did they make? More than the fine. Always more than the fine. HSBC paid $600 million. Scotiabank paid $127 million, plus another $230 million in separate cases. $360 million total. So much pain they exited the metals business entirely. Deutsche Bank fined, UBS fined, Barclays fined, over $1.3 billion in total settlements for manipulation, proven, documented, settled. And here's the problem. The fines did not stop them. They treat fines as cost of doing business, make billions manipulating markets, pay hundreds of millions in fines. Net profit's still massive, so they keep doing it. December 2nd, 2025, CFTC releases bank participation report. Combined bank position in COMEX silver, 212 million ounces net short. That's the official number from the regulatory filing. Banks are short 212 million ounces. At today's price, that's $20 billion of exposure. But wait, that's just COMEX. That's just the futures exchange. That does not count London. That does not count over-the-counter positions. That does not count swaps and options and all the other derivatives they use to hide exposure. Real number? Nobody knows. Some estimates put it over $300 billion of short exposure to silver. And they cannot get out. They are trapped, cornered. And cornered animals are dangerous. Here's why they cannot escape. First, no metal. COMEX registered inventories down 60%. London vaults supposedly hold 844 million ounces according to LBMA, but 4/5 of that is registered to ETFs, not for sale, at least to banks maybe, but not available for delivery. Shanghai stocks down 1,000 tons in 3 months. China restricted silver exports January 1st. 44 companies authorized. Government gatekeepers over 121 million ounces of annual exports. That's 60 to 70% of global refined silver trade. China is a net exporter, was a net exporter. Now they're cutting off the West and buying domestically. India behind on annual orders, expected to request 2,000 more tons. South Korea negotiated $76 billion order of precious metals with Shanghai Gold Exchange. The East is buying. The West has no supply. Second, they cannot manufacture silver. This is not currency they can print. This is not a balance sheet entry they can create. This is physical metal, mined from the ground, refined in facilities, shipped in trucks. Takes time, takes resources, takes mining companies months or years to increase production. Meanwhile, demand keeps rising. Solar panels need silver. Electric vehicles need silver. AI data centers need silver. 5G infrastructure needs silver. These are not optional purchases that stop when price rises. These are strategic industries with government backing. Price inelastic demand meeting constrained supply. Recipe for explosion. Third, the banks are short, not long, short. They bet on price going down. They sold contracts to deliver silver they did not own. They promised delivery at 70, at 80, at 90. Now price is 95. They are underwater. Every dollar silver rises costs them hundreds of millions, and they have to buy to close positions. But buying pushes price higher, which increases their losses, which forces more buying. Death spiral, already happening. TD Securities lost 2.39 million closing a failed short in October. That's one bank, one position, 1 month. Multiply that across 8 major banks, across hundreds of positions, across months of rally. Losses are staggering. The West is asleep, still watching CNBC, still trusting, still believing the paper price is real, still thinking markets are fair. The West sees $94 and thinks, okay, normal volatility, maybe a correction coming. The East is awake. The East knows. The East is buying every ounce, physical silver, not paper contracts, real metal. Because the East learned the lesson. 2008 financial crisis. Lehman Brothers went bankrupt. Counterparty risk became real. Paper promises became worthless. Physical ownership became everything. The East remembers. The West forgot. Look at the cascade. December 30th. Silver $72 in New York. $130 in Japan. Physical not available in most of Asia. Dealers apologizing. Mints closed for new orders. U.S. Mint announced shortages of silver coins. Premiums on American Silver Eagles reached $15 per ounce. Canadian Maple Leafs, similar. These are government-minted coins, 1 ounce of silver, should trade close to spot, instead trading 20% premium. Why? Because you can actually get delivery, unlike futures contracts, unlike ETF shares. Physical coins are real. China moved first. January 1st export restrictions reclassified silver from ordinary commodity to strategic resource. Government licensing required. Message to the West, we control supply. You need our silver. We don't need your dollars, not anymore. India followed. Increased import quotas, stockpiling. South Korea bought 76 billion of gold and silver direct from Shanghai. Not London, not New York, Shanghai. The financial center is shifting. The power is shifting. And the West is still pretending everything is normal. Shanghai premiums hit $8 per ounce consistently. Not one day, not 1 week. Consistently for 2 months. $8 over COMEX spot. That's 11% premium on every ounce, every day. Chinese buyers offering foreign suppliers $8 premiums just to secure metal. Still cannot get enough. Indian buyers offering $5. Middle East buyers paying $128 when available. The global South is buying. The global North is selling paper. Now ask yourself a simple question. If silver is available, why are people paying massive premiums? Why wait 3 months for delivery? Why are mints backed up? Why are dealer shelves empty? Answer is obvious. Silver is not available. Not physical silver, not deliverable silver. Paper silver exists. Computer entries exist, but metal? Scarce. Getting scarcer. Why don't banks buy silver in New York and sell in Shanghai? Arbitrage opportunity, right? $8 spread. Easy money. Answer is they cannot. 3 reasons. First, no metal in New York to buy. Vaults are empty. Or more accurately, vaults hold ETF silver that's not for sale. Second, cannot ship to China. Export restrictions. Government won't allow it. Third, banks are short. Banks don't want to buy silver. Banks want price down. Buying silver pushes price up, makes their short positions worse, so they sit and bleed and hope price crashes. It won't. Here's what happens next. Banks have 2 choices, close positions or default. Closing positions means buying silver, lots of silver, hundreds of millions of ounces. Where do they buy it? Market has no supply. COMEX has 48 million registered ounces. Banks need 200 million. Do the math. It does not work. They could buy ETF shares. But ETFs are trading at premiums too, and ETF silver is mostly leased anyway. Already spoken for. They could buy from China, but China won't sell. Export restrictions. They could wait for new mining supply. It takes years. Price will be 200 by then, maybe 300. They're trapped. Decide right now which side you're on. Default option. Even worse. If a bank cannot deliver silver on a futures contract, they cash settle. Pay the contract holder cash instead of metal. Sounds fine, except that's not what the contract says. Contract says physical delivery. If banks start cash settling en masse, the entire paper market collapses. Nobody trusts paper anymore. Everyone demands physical. Price explodes. Could see 500. Could see 1,000. Nobody knows. Never seen this before. JPMorgan's position is fascinating. They were the biggest manipulator, paid the biggest fine, sent traders to prison. And then something changed. Between June and October 2025, JPMorgan reportedly sold its entire 200 million ounce paper short position, closed it, bought it back, and started accumulating physical. Current estimates put JPMorgan's physical silver stockpile at 750 million ounces, largest in the world. They flipped. From biggest short to biggest long. Why? Because they saw this coming. They knew the paper market would break. They knew physical was the only safe position, so they got out, built the greatest silver hoard since the Hunt brothers. And now they wait. When the paper market collapses, JPMorgan owns the supply. They set the price. Smart? Or insider manipulation? Both, probably. Other banks did not follow. HSBC still short. Scotiabank was but got crushed and exited. Citigroup still short. Deutsche Bank still short. Goldman Sachs still short. They're still playing the old game. Suppress price, make money on shorts, collect fees on ETF management. Except the game changed. The East stopped playing. Now these banks are holding paper shorts against Chinese physical buying. They will lose. They are losing. Own physical silver. Do not sell. Do not even think about it. You hold the winning ticket. The screen price is fake. It's a computer number generated by banks trading contracts they cannot fulfill. Real price is what people pay for actual metal. Shanghai pays 104. That's real value. Japan pays 130. That's real value. Your physical silver is worth what someone will pay you for it, not what COMEX says. COMEX price is falling apart. Physical price going higher, much higher. Your silver is safe. Your silver is scarce. Your silver is valuable. Hold it. Do not let banks talk you into selling physical for paper. They want your metal. Need your metal. Don't give it to them. Own paper silver, ETFs, futures. Consider risk carefully. Do you trust your counterparty to deliver? SLV is managed by BlackRock. Custodian is JPMorgan. You comfortable with that? JPMorgan holds 517 million ounces for SLV. Same JPMorgan that manipulated silver for 8 years. Same JPMorgan that paid 900 million in fines. Same JPMorgan that has 750 million ounces of their own physical. Conflicts? Maybe. If supply gets tight, where does JPMorgan's loyalty lie? With ETF holders or with themselves? Think about it. In futures contracts, COMEX Rule 802 gives the exchange absolute right to change margin requirements at any time without notice. They proved it. Raised margins 47% in 1 week. What if they raise them again? What if they suspend trading again? What if they force cash settlement? Your paper contract becomes paper cash. Not silver? Cash. At whatever price they decide. Own nothing? Question isn't, should you buy? Question is, can you still buy? Physical silver is disappearing from the market. Dealers are sold out. Mints are backed up. Premiums are 15 to 20%. In some places, 80%. This is not a dip buying opportunity. This is a supply crisis. Window is closing. Fast. Every day more people wake up. Every day more money flows from paper to physical. Every day supply gets tighter. You wait another month, might not be any silver to buy, or premiums could be 30%, 50%. Who knows? Never seen this before. My advice? If you want silver exposure, get physical. Now, not tomorrow. Now, go to a dealer, pay the premium, take delivery, store it yourself, not in a bank, not in an ETF, in your possession. Last warning. Silver went from $31 to $95 in 1 year. That's 200%. Mainstream analysts are scrambling to update forecasts. JPMorgan said silver would average $32 for 2025. Missed by 100%. They were in the wrong ocean. Citi estimated silver would average 36 to 38. Also wrong. Now they're talking about rebalancing and mean reversion. Translation? They need price lower to save their positions, but fundamentals don't care about their positions. Supply deficit continues, 4th year in a row. 820 million ounces cumulative deficit from 2021 to 2025. Above ground stocks depleting, industrial demand increasing, solar panel installations growing, electric vehicle production growing, AI infrastructure growing, all need silver, supply not keeping up, simple math. Long-term forecasters see this clearly. CoinCodex predicts silver trading between $95 and $972 in 2026, average of $403. That's potential return of over 900% from current levels. By 2030, they see $1,170 to $1,592. Some conservative analysts say $375 by 2028. I think conservative. Way conservative. With supply this tight and demand this strong, could see 400, could see 500, could see 600. Depends on when the paper market breaks, when banks start defaulting, when physical becomes unobtainable at any price. Then silver becomes whatever holders want. They set the price, not exchanges, not banks, holders. The parallel to 1980 is obvious. Hunt brothers tried to corner silver, bought massive amounts using leverage, futures contracts, margin debt. Price went to $49. Exchange changed rules. Silver Rule 7 restricted buying with debt. Forced liquidation. Hunt brothers lost billions. Silver crashed. But here's the difference. Hunt brothers were leveraged. They were vulnerable to margin calls. Current situation? Chinese government buying, Indian government buying, South Korean government buying. These are not leveraged speculators. These are sovereign nations with trillion-dollar reserves. They can't be margin called. They can't be forced out. And they're buying physical. Not paper, not futures. Physical metal. Taking delivery. Storing in their vaults. This is not speculation. This is strategic accumulation. This is preparation for currency crisis, for dollar decline, for monetary reset. Silver is money. Been money for 5,000 years. Will be money again. Right now, you're watching history. The paper monetary system is cracking. The debt bubble is bursting. The currency debasement is accelerating. And smart money knows. That's why silver is exploding. That's why physical premiums are massive. That's why governments are hoarding. They see what's coming. The system reset, the return to real assets, the collapse of fiat confidence. Silver is the tell. Silver is the canary in the coal mine, and it's screaming. 3 things you must do. First, like this video. Share it. Send it to everyone you know who owns silver, everyone who trades metals, everyone who trusts banks. They need to see this. They need to understand what's happening. This information is not on CNBC, not on Bloomberg, not on mainstream financial media. Why? Because banks advertise there. Banks control the narrative. Banks don't want you to know, so share it, spread it, make it viral. Second, subscribe to this channel. More information coming, daily updates on silver market, real-time analysis of what banks are doing, what China is doing, what happens next. This story is not over. This is the beginning. Silver could go to 150, could go to 200, could go higher. You need to know, you need to watch, you need to stay informed, subscribe, hit notifications, don't miss updates. Third, take action. If you own physical silver, hold it tight. Lock it up. Don't sell, don't trade. Don't let anyone talk you into paper. Your metal is your wealth, your security, your insurance against system collapse. If you own paper silver, consider your risk. Evaluate your counterparty. Think about converting to physical. If you own nothing, decide now. Are you in or out? Silver is moving. Train is leaving the station. You can board or you can watch. But decide fast. Window is closing. The banks are trapped. JPMorgan, HSBC, Citi, Deutsche, Goldman. They bet against silver for decades. Made billions suppressing price, protecting their positions, protecting the dollar system. But now the system is breaking. China won't play along. India won't play along. The East is done with Western financial games. They want real assets, real money, physical silver. And the banks cannot stop them, cannot manipulate them, cannot force them out. The tables have turned. The suppressed is becoming the suppressor. The shorts are becoming the squeezed. And we're watching it happen in real time. Get out of paper. Get into physical. Now. Now. Time is running out. Supply is running out. Your opportunity is running out. This is not a drill. This is not a maybe. This is happening. Silver is breaking free. The manipulation is ending. The real price is emerging. And it's much, much higher than $95. Don't be late. Don't be on the wrong side. Don't be holding paper when the music stops. Get physical. Get real. Get silver. Go, go, go.